Number one is you have to own investment property. If you have a residence, your personal residence, that is not a depreciable asset. So that's number one. Number two is this may sound facetious, but bottom line is you have to pay income tax. So if you're not paying income tax this year, wait until your accountant or your software tells you have to write a check to the IRS. So if you're not paying income tax, don't call Joe. Number three is there's a concept in real estate where you have a passive versus active investor, and the kind of losses that we give our clients are the type of investor they are in real estate. So if they're a passive investor, we give them passive losses. If they're an active investor, we give them active losses.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Joseph Viery. Joseph is the founder of U.S. Tax Advisors Group, Inc., a publicly traded company, and a firm that works mostly with real estate investors, helping them save hundreds of thousands and sometimes even millions of dollars on tax. And they do that by using cost segregation. And in just a minute, we're going to speak with Joseph Viery about cost segregation. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Joseph Viery. Welcome to CREPN Radio.
Thank you, Darren. Thank you for having me.
Well, I'm looking forward to our conversation, but before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure. Basically, my background is one that I was an entrepreneur since college. So I got out of college and I started a business, and it was not related. I was a business management major, and I started my own business, which was travel. So it was special interest travel. And then I sold the business in 2000, and I started working with the California Association of Realtors. And I was into financial planning and tax strategies for their members and the members' clients. And then you know what happens in 2008, the car went off the cliff, and I had done a couple of cost segregation studies for some clients who had enormous tax bills that they couldn't pay. I'm talking about personal income tax. And so I found out about the strategy, got them involved in accelerated depreciation. They were very grateful. And then the California Association of Realtors, with the whatever you want to call it, depression, earthquake, pretty much that part of my career stopped. And the guy who I worked with to do accelerated depreciation said, "Hey, you're really good at this. Why don't you come and work for me?" And that was in 2007-8. And I started cost seg. And I've worked for a couple companies. And about 7 years ago, I founded my own, which is U.S. Tax Advisors Group Incorporated. A lot of our clients like to say USTAGI or USTAGI.
Got it. So where are you located right now?
Well, we're a nationwide company. We've done buildings every state in the union. And bottom line is I happen to be located in San Diego, but we've got staff pretty much throughout the country.
Got it. That's kind of what I was curious about.
Yeah.
So let's start with just defining what cost segregation is.
Great, great. That's a good question. Let's start at the very beginning. Basically, real estate is a rich investment platform. And if you don't know the reasons why, you can listen to one of Darren's other podcasts about all the benefits of real estate. One of the strong advantages are the tax benefits. And so that's where we come into play. And basically, all it is you have gross taxable income. I'll make up a number, $100,000, and and that's your gross taxable income. You have no expenses. You will pay income tax on the 100,000, which if you're in the 30% bracket is going to be 30 grand. Now let's say that you do a cost seg report and I give you $50,000 in accelerated depreciation. What is it doing? It's reducing your gross taxable income in half. I've just saved my client $15,000 in income tax. So to explain it, it's very simple, but what you do need to have is an experienced engineering-based company that knows all of the IRS rules and regulations, that knows what building components can be accelerated and which ones can't. And what we do as engineers is we reverse diagnose the building, meaning we go into a building that somebody bought, and let's say the basis is $100,000, made up number. Then what we do is we put all of the building components, what went into building that building, into its life, its correct life. And if you do it correctly, you're going to have shorter acting life, which is an expensible opportunity. And then you're going to have your regular walls and doors and roof, which will stay in the actual long-term life. If you do not accelerate your depreciation, what the clients and their accountants are doing is they're using straight line. And straight line for residential is 27 and a half years. You divide the building basis, which is what you paid for the building, less the land, because land is not a depreciable part of that building. And that building basis, if it's a residential building, you divide by 27 and a half years. For commercial buildings, it's 39 years. And you can see that, if you're waiting 39 years to get your little bit of depreciation, not much of a benefit in year 1 through 38. I mean, just 39. There's not much benefit. If you accelerate that and you get it up front, now you're talking about the time value of money. And the time value of money is so critical in real estate because you don't want to be paying your taxes 39 years down the road. If you have a tax benefit, you want to take that write-off the year you get the benefit. And that's what we give our clients.
So tell me, and I get the acceleration. I mean, I've used cost segregation on a couple of my properties, and it is an eye opener from my situation. I went from owing a bunch of tax to getting a return. I was like, it was significant. So more than offset the cost of doing it. But what I want to ask you is, who does this help? And I say the who, meaning that does it help more of somebody that's just bought a property, or does it help somebody that currently owns a property, they've had it for a number of years?
Great question, Darren, because this is one of the facets of what I do that a lot of people are unsure of. Basically, we can do the accelerated depreciation. It works really well if you get to us when you buy a building. So if you bought a building in 2024, you'd want to call us immediately, get a no-cost estimate, find out what the fee is going to be, and then you and your team, your advisors, because we're not accountants. So U.S. Tax Advisors Group, we're not accountants. We are only engineers who perform cost segregation. So go to your team, which we advise everybody, and decide whether this is for you. But I will tell you that there's very few reasons why one would not want to at least look and get the estimate for cost segregation. And I'm going to go through them really quickly because it won't take long. That's how few there are. Number one is you have to own investment property. If you have a residence, your personal residence, that is not a depreciable asset. So that's number one. Number two is this may sound facetious, but bottom line is you have to pay income tax. So if you're not paying income tax this year, wait until your accountant or your software tells you have to write a check to the IRS. So if you're not paying income tax, don't call Joe. Number three, is there's a concept in real estate where you have a passive versus active investor, and the kind of losses that we give our clients are the type of investor they are in real estate. So if they're a passive investor, we give them passive losses. If they're an active investor, we give them active losses. The reason this is important is because in the 1980s, I'll pick on doctors. Doctors were buying a lot of rundown, non-functioning buildings only to get their depreciation expense to lower their income as physicians. IRS and Congress said, no, 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 you can't do that. If you do that, we're going to make you a passive investor. You're getting your primary income from being a physician. Real estate is a passive investment, and they put a limit on it. So therefore, and the limit depends on the investor, but the limit is about $30,000, $40,000 per year. So obviously, if you own a $2 million building and I'm going to give you a $500,000 depreciation write-off, accelerated depreciation, I'll probably advise you not to do it because it's going to take you over 10 years to use your bucket of losses up. However, if you bought a single family home for $400,000 and I give you, say, $80,000 in losses, I'll say, yeah, why don't you should probably do accelerated depreciation because it's going to take you a couple years. If you're maxed out at $40,000 in losses, it'll take you $40,000 the first year. That'll roll over the $80,000. You'll have another $40,000. So it makes sense to do cost seg. But if you have a large building and you're passive, you may not need to do cost segregation. The other factor is on a 1031 exchange. If you, when you do a 1031 exchange, when you sell your building, that's called the relinquished basis. It flows over into the new property so that you can avoid paying taxes. Bottom line is, in cost seg world, the basis of the building you sold or the relinquished building must stay in the form of depreciation. Most of the time, it's going to be straight line. So I can't touch that. So an example is if you bought a building for $500,000, if you sold the building for $500,000 and you bought a new building for $550,000, a straight exchange, I've only got $50,000 to work with. I'm rounding up to give you the concept. So I would tell you don't bother doing cost seg. But what happens is most investors trade up. They sell a building for 500, they buy a new building for $1 million. Now I've got 500,000 to play with to accelerate cost segregation. So those are the only circumstances where cost segregation may not be a play. But I'll tell you, Darren, it really is a huge universe out there of people who own property that pay income taxes that should be doing accelerated depreciation.
Right. So in that, you mentioned kind of some varying sizes of properties. Is there a hurdle or a value where you say, look, if it's below this, I wouldn't bother with it. If it's above this, then by all means, take a look at it.
When I first started, that was a factor. Meaning, when I first started doing small buildings, we're one of the few out there that do smaller investment real estate. And the most common, of course, would be single family homes. So if you do a single family home, in the old days, we couldn't touch them because we would have to fly somebody out to the location or they have to travel to the location. So that's a big expense. And it's a whole different concept. And we would do what's called the detailed engineering report. Those reports cost thousands of dollars. Doesn't make sense for a building that you bought for $250,000. So we developed, we call the modeling technique, which is an analytical desktop review where the engineer stays in the office. So therefore, it's very affordable. What's that mean for your question? I mean, right now, I would be really surprised if I found a building out there that wouldn't make sense. By that, I mean, if you have a building basis under 50,000, it's probably not going to make sense to do the modeling study. But obviously, to find a building with a basis under 50,000 is pretty tough nowadays. In the old days, 7 years ago, there were still a lot of those out there. Nowadays, I haven't seen a small building in so long because everybody's buying, minimum 100,000 across the nation. Not California, by the way. I understand. Definitely not California, but across the nation, I mean, you can really get some very nice investment properties in many municipalities where the building basis is really low. But I would say, to answer the question, $50,000 is probably in the area. But even that, I would tell the prospective client, just get the estimate. We'll give you the estimate, no cost. Then let's make a decision. If I don't give you 10 times the fee and benefit, then I'm going to tell you don't do it. So if I charge you $675 to do a modeling study, I want you to save $6,750 in income taxes. And we almost all the time give at least 10 times what the fee is. That's our benchmark. If you don't get 10 times, I'm going to tell you, don't do it. I believe don't do it. Now, if you want to do it, it's okay, but I'm going to tell you, I don't think the value proposition warrants. If you gave me 675 and you only get $4,000 in benefit, I'll tell you, I don't think that's a good bet.
No, makes sense. So let's say somebody's listening to this, they realize they've got either a new purchase or they've got a tax bill and they're trying to, get out from under the tax bill. They call you. How long does it take to do a cost segregation study?
And that's a good question because we're in the tween zone right now because we had people who filed the 2003 taxes on time, either March 15th or April 15th. The first date, March 15th, is for entities like LLCs and LPs, which most people own their real estate in. The second one is for sole proprietors, the second date. So now we've had people who filed 23, that's put to bed. Those folks are in the 24 tax year. If you're on extension, which most of my clients seem to be, September 15th is for entities. October 15th is for individuals. So bottom line is right now we can still get work done for the September 15th, but we're getting near the deadline. But bottom line is this: once we get all of the information we need on the property, we tell our folks 30 days before you can get the report. However, if you're in a hurry, if something happened, we rarely turn somebody back. It's just we have to look at our pipeline, see if we can get the project done. But to give you and your listeners an idea, 30 days from when we get all the information. If we have to go out on the bigger buildings and do a site inspection, that means after we do the site inspection, after we collect any documents you have, and we don't need a lot of documents, but we do like documents. We like things like, if you have them, which is rare, building plans, and then the closing statement. And if it's a look back study depreciation schedule. And I'm going to interrupt really quick, Darren, and just say that I forgot one thing, and that is we have current tax year studies. That means 2003 or 2004 purchased properties. But one of the major benefits that people don't understand is we can go back this is not set in stone, 15 years and do a study and have it make sense. So obviously, if you go back 15 years, you've paid depreciation for those 15 years. We got to factor that out of the equation because you can't double dip. But even if you take that off by the 15 years of depreciation, by the acceleration of the depreciation, usually factoring in all of the factors, it's still going to make sense. So those who've owned a property, and I don't care how old the property is, George Washington could have slept in the property. All I care about is who owns the property now and when did they buy it. If you bought the property last year, the depreciation clock starts all over again, and you would be a good candidate to do cost seg. Any type of building, any age of building, as long as the entities who bought it, the investors who bought it within about 15 years.
Got it. Couple of questions here. IRS, how do they view this? Are they pro cost segregation studies, or is it something that's kind of like a gray area?
No gray area. That's one good thing. When I first started in 2007, 8, people, accountants would say, "Oh, no way. This is not legal. This isn't legal. This is." They tell their clients, and I would give them the rules and regulations. And bottom line is, it's the IRS. What happened is in 1997, the IRS got called into court by the Hospital Corporation of America. They sued the IRS, making this claim. They had a lot of personal property and land improvements in the property, which are the two buckets we work with when we accelerate depreciation. And the IRS said, no, you can't do that. And the judge who tried the case was so miffed at the IRS and their defense that he had a lot of provisions put in there to actually make it tough for the IRS, because he told the IRS, look, you admit in court this is the way investors should depreciate a building, and yet you're not telling them they can do this. So basically, since 1997, the IRS, and if anybody does not believe Joe, I will tell you what my Bible is. This is the best place to go. Google audit technique guidelines for cost segregation, or ATG for cost seg, and you will find the 200+ page document where the IRS tells their agents everything you need to know to do a quality study. That's my Bible. We follow that to a T. So everything we do is IRS compliant. You will not get audited for cost segregation. You might get audited for some other reason. They may see that the client did a cost seg, and then they may say, hey, we have a question. We answer the question, and that's the end of our part of the defense, because we do everything correctly.
All right. So we sign up, you guys do a study, get the results, everything's on a schedule for depreciation. Part of the buyer's strategy for this property was kind of a value add. They're going to do some capital improvements. Can you talk about how what are the mechanics for capital improvements, and what needs to occur in order to get the maximum benefit for a some capital improvements?
I'll distill that to make it very simple. Bottom line is, again, I'll reemphasize that we deal in building basis. And what does that mean? That means anything that's capitalized over that long term. For residential, 27 and a half years. So when you do improvements, today's age, basically the IRS does grant you a lot of write-offs. So the first part of that equation is, if you are doing improvements, first of all, find out what you can legally write off. The number one tool you have in your tool belt is write-offs. You want as many write-offs as possible. Cost segregation is one of those, accelerated depreciation. So bottom line is, you want to make sure, I'll make up a number. You spend $200,000 on improvements. A lot of that can be written off. For example, what, Joe? De minimis. That means anything you paid $2,500 or less in a receipt is an immediate, no questions asked write-off. And there's a whole bunch of rules in expensing and writing off properties. So number one is you get rid of the write-offs, because that's going to, write-off is number one. What's left are capitalized products or components. For example, like what? A roof. That can't be written off. A roof is your new roof is completely capitalized. So what does that mean? It goes into the building basis. Air conditioners, capitalized, does not go into. So bottom line is, once I know all of your capitalized expenditures, we will do a cost segregation study, which will include the original basis of the building, will include all the capitalized costs from when you did the improvements. We add those two together, and we give you a report for the new basis of your building, whatever date that new basis occurred. If it's a look-back study, we can do this process on properties you did improvements for 3 years ago. But most of my clients, they buy a property in the current year, they fix it up, and then they put it on the market and they sell it. In that case, we just combine those two amounts, the original building basis, the improvement building basis, we add them together and we do a cost seg study. But here's the important thing that taxpayers should realize, and this is really valuable, is that bottom line is, whenever you do an improvement, you are taking products, components of the building, and you're throwing them in the trash. Guess what? Those are write-offs, because the IRS does not want two roofs on your depreciation schedule. You have the roof baked into the original acquisition, which we tell you what it is because we're engineers. We'll tell you what the value of the roof is. Now you put on a new roof. Well, if you put on the new roof and you capitalize the new roof, which is the way to do it, now you have two roofs. You have the new roof and you have the old roof. The IRS says, no, write that old roof off. How do you know the value? You do the cost seg report. We give you the value of the roof. You write that off your taxes. So now what do you get? You get the acceleration on the original asset. You get the acceleration on the improvements that were capitalized. And you can also now calculate your write-offs. A lot of accountants and taxpayers don't understand that this powerful part of the IRS code is to write off everything you throw in the trash. So that means when you're doing your work, do the calculations. You threw away, I'll make it up, 1,000 square feet of drywall. Write that down because we need quantities of what you threw in the trash. Items. Here's the light fixture. We threw 30 of these away or 10 of these away or 5 of these away. So bottom line is that's a very important key part of our world, Darren. So to answer your question, yes, we do improvements. We do the original basis, and we also calculate or give the owner of the building the disposition amount. We do that calculation, so we make it easy.
And just a pro tip, I had a situation where I had a building, and we before we had how did this go? I guess we'd done the work, and it was only after we'd done the work and actually filed for that prior year that we went and did a cost seg study. And if I understood right, we weren't able to get the disposal of the stuff that we took out because we'd already filed. Unless it seemed like there was some sort of a
No, that's right.
there was we missed an opportunity, and I was frustrated by that. But note to self.
Yeah, you have to take the dispositions in the tax year that you did the work.
Right.
So if you're on extension right now and you did the work in 2023, the window's still open. However, if you filed your 23 taxes in March 15th, then that window's closed. You cannot take dispositions. You can take them for anything you threw in the trash in 24, but not in 23.
Right. Now, that was a lesson that I learned, and it kind of burned me because the time I'd done it before, that was kind of like a big appeal. It's like, oh my God, you get to, the disposal of all this stuff, and because you're recapitalizing all of it, so it made good sense. Let's see here. So talk about, do you guys work with the accountants to coach them through how to use the information, and tell me about how that works?
Yeah, we do that. That's part of our service. Basically, we're not accountants, so we're never going to tell an accountant what he or she should do. But we are going to give them our opinion because we've been doing this for so long, and we do have members on our team that are very savvy in accounting and know the IRS rules and regulations, blah, blah, blah. So bottom line is, if an accountant needs help and they need to have any explanation on what we do and how it works, and how to file, for example, when you do a look back study, meaning you've already filed your tax return and now you're going back in time to do, remember I said you go back 15 years, you have to do a form 3115, which is called the change of accounting method form. You have to let the IRS know, okay, I was using straight line. Now I'm using accelerated depreciation, and here's the math. We took this much depreciation since owning it, and this is the new accelerated depreciation. And bottom line is that form, a lot of accountants are not familiar with the form 3115. So if they're not familiar with it, we will coach them and show them how to do it. So anytime an accountant has questions, one of our strengths is you just call your sales contact at Ustagi, and we'll get on the phone or a Zoom call with the accountant, and we'll go through and we'll explain all the rules and regulations and the correct way and the incorrect ways of filing this tax return.
Got it. For the depreciation, we are accelerating the depreciation. We're not getting additional depreciation, correct?
Beautiful point. Yes. If you do the math, all the way through day one when you bought the building to 27 and a half years down the road. By accelerating the depreciation, you add up all your depreciation after 27 and a half years, that's going to equal exactly what you would have gotten if you did straight line. So you're not getting any extra. It's the time value of money. It's giving you those losses in the tax year you do the study. That's the power. You want those losses today. You don't want to wait 27 and a half years to get those losses.
Oh. And as somebody who's done a couple of these, I can't recommend them enough. Um, I mean, it's amazing the power of depreciation. It is the kind of the gift that keeps giving with real estate, and it's the thing that makes real estate work for the most part is that depreciation, being able to write down your income for a lower tax bill there. So I can't recommend it enough. Um, is there anything that we've not covered with respects to cost segregation that you would have liked me to ask you?
Yeah, let's talk just one little subject called depreciation recapture. So that would be one of my old misconceptions on my original list of 20, all these crazy questions accountants say, oh, you can't do cost seg because of this reason. I told you there are very few reasons, but one of them that I got was depreciation recapture. And just so the investor knows, what happens when you sell a property for cash, not a 1031 exchange, if you pass away and it goes to your heirs, it's not going to be when the property is passed in that method, death of the primary owners of the real estate won't come. But if you sell a building for cash, you have to pay depreciation recapture, which is 25% of the depreciation you've taken. So some accountants back in the days would say, well, if you're going to just have to pay it back when you sell the building, then why would you pay Joe to do the study to get accelerated depreciation? And here's the reason why. This comes from not Joe, but from my savvy accountants and CFOs of large portfolios. And basically what happens is this. It's like buying a laptop 5 years ago. I'm just going to use 5 years. You buy it for $2,000. 5 years down the road, you want to sell that laptop. What's it worth?
Nothing.
Probably nothing. Probably parts. You can go on eBay and get somebody to buy a junked up laptop, slow laptop for $50 or $100. So they make the same argument to the IRS. What they tell the IRS is, okay, Joe defined the 5-year property. You're selling the property for cash 5 years later. What's that 5-year property worth? You think that carpet that I valued it, I'll make up a number, $5,000 is worth $5,000 5 years later? Probably it's not worth 50, 100. You have to probably pay somebody to rip the carpet off out. It doesn't have any value. So what they're telling the IRS is and again, I'm making the math simple. 5 years down the road, the 5-year property has little value. You're gonna give it some remaining basis, but not much. Whatever you feel, whatever you can get from the accountant to value the basis of the 5-year-old carpet. And then for the 15-year land improvements, you're going to take that 15-year and you're going to say a third of that is taken off the table for depreciation recapture because a third of that has been used up over time. So bottom line is cost seg reduces depreciation recapture. Very, very, very important concept. Ask your accountants. You can always call me and I can explain it to your accountants, but that's really powerful because if you're selling for cash, you don't want to pay 25% of your depreciation recapture back. You want to avoid it as much as you can.
Yeah, and even to that, I think that's one of the the big ahas when you do hold a property long term. I mean, 5 years doesn't seem like a long time. I mean, it's certainly a good timeline for using the cost segregation to get that depreciation up front. But if you've held it for even longer, it can be, a bigger number. But to your point, the fact that it's all used up, or mostly used up, as far as an argument goes, that's kind of an interesting angle, because that cost or not cost seg, but that depreciation recapture is kind of a like, oh, the other side of the sale thing, which I think promotes a lot of people to do the 1031s. to avoid,
Sure.
having that tax bill.
One thing I failed to mention is that what we recommend also is that you have to be a holder of real estate for about a year and a half to 2 years, because there is depreciation recapture. And if you're not holding your money, doing something with the money we saved you, then, we will tell you don't bother doing it. So if you're a flipper, flippers are not good candidates for cost seg. And the reason why is because of the depreciation recapture. So you do have to hold it for at least a year and a half, 2 years to make the numbers work efficiently.
Right.
So,
Hey, Joe, if we could, I'd like to shift gears here for a second.
sure.
By day, I'm an insurance broker, and I work with my clients to assess risk and determine what to do with the risk. And there's 3 strategies we typically consider. We first look to see if we can avoid the risk. When that's not an option, we look to see if there's a way we can minimize the risk. And when we cannot avoid nor minimize, we look to see if we could transfer the risk. And that's what an insurance policy is. And as such, I like to ask my guests if they can look at their own situation. It could be your clients, investors, legal climate, the Fed, political, whatever it is that you identify and consider to be the biggest risk. And
Politics,
again,
political.
yeah, and again
Sorry, it's really the big one, because I'll give you a real good example. We're talking about there's a concept called bonus depreciation, and bonus back in the the Trump tax law was, remember I said I find short-lived assets. They're primarily 5, 7, and 15-year assets. Any asset under 20 years is subject to bonus depreciation. It was 100% until 22, and then last year 23 is 80. This year it's 60. Bonus depreciation, I think, is completely overrated. Don't forget, we did not have bonus depreciation for my first 12 years of doing cost seg. So I don't consider it's just the timing of the benefits is all bonus means. But bottom line is, Congress passed bonus depreciation extension, and it's been sitting in the Senate since January or February, I think, since February. So politics is just really one of the things that, I don't have a crystal ball, and that's one risk. Boy, I wish I could buy from you, Darren, an insurance policy against bad mistakes by politics.
Yeah, no, you and a lot of other people as well. Hey, Joe, where can the listeners go if they'd like to learn more or connect with you?
Easy. It's Ustagi, USTAGI. So if you want a no cost estimate, then go to USTAGI.com/get started. GET-STARTED. So USTAGI.com/get started, and that'll take you to our website. And when our website, then you can fill out information about your property, and then we'll return back in a couple of days an estimate and a fee, and then you can take it to your team and discuss if it's worthwhile going in this direction. And people can they can find me on the ustagi.com, and they can call me up and talk to me if they want. My cell phone numbers on there. So if anybody has any questions, just get in touch with one of our team members or get in touch with me.
Awesome. Well, Joseph Viery, I cannot say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Well, thank you, Darren. Appreciate it.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.